All right, my name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about state tax filing requirements, specifically for those who operate small businesses or they are a part of investments, whether that be, say, real estate, or they might be a passive partner or a shareholder in either an S corporation or a partnership, specifically the flow-through entities. The flow-through entities are partnerships and S corporations, where you receive a K-1 or a document indicating how much you need to report on your individual tax return. But the idea is that the company or the business income is reported on the company's tax return, and you report that share of the income on your personal tax return. Another example would be if you own property in another state other than where you live. So you live in one state, you have an investment property in another state. So I came across this the other day, and it was a little bit of a dilemma or a decision that needed to be made as far as the filing requirements in those states where the company operates or where the property is located. In this particular instance, I had a client who was a part of a partnership because he was a part of a syndicate that invested in a large property in another state other than where he lived. So the syndicate created a loss for that individual. It was a real estate based loss, so it's a passive loss. Because it was a passive loss, and this was the only activity that this person had in this state, they're below the filing requirement threshold for that particular state where the property is. So they don't need to file a tax return for that state by law. So you could just act like it didn't happen, or just, I shouldn't say ignore it, but you don't need to file. And you would be perfectly fine because it's a loss in that state, and that's the only activity for that state. So state's not looking for you. However, there is an issue whether you should actually still file in that state because you want to record the losses. So in this particular instance, it created what's called a net operating loss, or NOL, which just means that from all the activities in this state, you operated at a loss. You had negative income. And on the federal side, in most states, if you do have a NOL, net operating loss, those losses are allowed to be carried over to future years. So what you're faced with is, even though you're not necessarily required to file in that particular state, you may still want to file to record the net operating losses, just to have that on record. Because if you do eventually start making money and turn a profit in that state, you can use those losses from the previous years to offset the actual income. So going back to my client, after learning more about this particular plan, that it was a larger property that will eventually be flipped. So it will be sold, and obviously the idea is when you sell like that, you're looking to do so for a profit. So the client will eventually realize a gain. So it might be in this client's interest to go ahead and file the state's tax returns to simply record those losses for when they eventually sell. Because right now, you record the loss, it doesn't really do anything for your income. You don't get a deduction, you don't get any benefit for that state because they can't tax you on money you never made. But you eventually will when they go to sell the property. So it's a good idea to record those losses and file those returns, even though you don't have an obligation to. It's usually a good idea to do is to record that loss so that you're not being questioned when the gain comes up and you look to apply those losses. Because if you don't do it, you may get questioned as far as where the losses came from. And another thing to consider is you also have to make sure that the losses are significant. If it's a loss of a very small amount, then it may not make sense to go ahead and file that return. But if you're looking at some pretty heavy losses that you think could be of benefit in future years, then you should go ahead. So that's all for now. Hope this was helpful. And if you have any more questions about this particular subject or any other accounting or tax related questions, feel free to reach out. Happy to help. So that's all for now, and I'll see you on the next one.